Hello, everybody. Kirk Spano, Fundamental Trends, Margin of Safety Investing, the Macro Dashes show. And we'll talk about some ETFs that are in our Global Trends ETF portfolio today, and about the dollar, the Fed. That's what everybody's thinking about. And of course, everybody's thinking, oh, should I buy into this rally? And I'm not so sure it's a great idea. Here's what I see. I think that the Fed sees what I see. I think they understand that the United States economy is tremendously strong, and it's going to get stronger as the millennials continue to push into their peak earning and spending years. But they also see that the baby boomer retirement crisis is going to be full effect late this decade, early next decade. So we have to consider what the Fed is really positioning for. Are they really managing the short-term business cycle, or is there something else going on? As you know, I have said over and over again that the Fed's real job is to control the dollar. And when they control the dollar, they essentially control everything else. As we get to the end of the petrodollar age, we should be asking what's going to replace that. Do we need oil priced in dollars to make the dollar strong, or do we simply rely on an American economy that is reshoring key industries and developing supply chains that leave us less reliant on the rest of the world? Do we suddenly become the exporter of quality goods and high-end services that we were decades ago? Or do we start to fall behind China and India? I think it's unlikely that we fall behind either one of them. However, it's a fear that many people have. And we will actually talk a little bit about India today. I believe that the Federal Reserve is pushing for a return to normal-ish for long-term interest rates, and they use short-term interest rates to manipulate the funding mechanisms for the U.S. Treasury with a more normal rate structure, something that we saw over a longer period of time, over decades, with interest rates in that 4 to 5% range on the 10-year and 20-year Treasuries. That gives the Fed a lot of room to maneuver when it comes to managing the dollar and managing the economy and helping the government manage geopolitical affairs. As we've talked about, probably 20 times, former Federal Reserve Chairman Ben Bernanke once had a very famous lunch with hedge fund managers who paid to eat that lunch with him. And he said he did not expect normal interest rates again in his lifetime. That was 2010, I believe. And here we are in 2023. And suddenly we're approaching normal-ish interest rates. A year ago, I said, and actually about a year and a half ago, I said that the Fed was reloading its bazooka. And that's what's going on right now. So if we get to a point where the millennials putting into the economy can't pay for the boomers taking out of the economy, the Federal Reserve will have created a big pile of ammunition to use to get us through that 2, 3, 4, 5-year period, if and when it comes. Between now and then, the next 6, 7, 8 years, it's probably about protecting the dollar. Can we refinance our debt while keeping the dollar and interest rates higher? And certainly there's going to be some waviness, and I'm sure the QE comes back at some point. But does it come back because of a baby boomer retirement crisis, or does it come back because the Treasury can't find investors, people to buy U.S. Treasuries? I think the odds are against that. I think that the world is very thirsty for dollar-denominated assets, and I really don't see that going away because we have the best big economy on the planet right now. And that probably lasts another generation or two. And by then, I don't know. I really don't care too much at this point because that's 20, 30, 40 years away. And as an investor, that really doesn't help me. But what I can see over the next 5, 10, 15 years and up to 20 years is that the dollar is going to remain in a higher range because right now the Fed is trying to protect it, although they've given a little bit on that, it seems like. But they know what I know. I mean, if I know it, they know it, that the millennials are that strong of a force in the global economy, that simply by virtue of them working, buying houses, and raising families, the U.S. economy will be ridiculously strong, much like it was when the baby boomers went through the same part of their life. Again, at some point, we have to pay for the baby boomer retirement. That will be a transition phase. However, by the 2030s, when we have essentially no dependence on global energy markets, and in fact, we're on the verge of already becoming a net exporter of energy, cheap energy, primarily for us, but also the rest of the world, is going to change the whole dynamic of how currencies work. It will come down to, and this is why you're seeing the competition with China, who is making the best stuff with technology that is supported around the world, and who is providing the best services and financing. The United States is in a position to lead on all of those things, and it should not be shortchanged that our system of government is so much better than anybody else's on the world export stage that will give us a perpetual advantage. It has for decades and decades, generations and generations, and people really shouldn't expect that to change. While the EU is a wonderful idea, the idea that they would ever really truly work together, the North and the South, Germany and the rest, has proven to be marginal at best. And anytime there's friction in Europe, you worry that they're going to break up. Brexit already happened. Take a look at China. Nobody trusts the communist regime, and that's never going to change. Japan is too little. Nobody trusts Russia. Although I will say, if Russia ever decides they want to adopt government and institutions that are similar to the United States, they would be a powerhouse. I don't really expect to see that, but you never know. India has a super powerful economy, and they're young, so we have interest in them because they are wonderful with technology and production, and they are moving towards a lower cost energy regime as well. The whole world really is. Energy is going to get very cheap later this decade as alternatives come on and as panic pumping occurs. Countries with oil deciding, oh my gosh, look at all these EVs coming. We better sell the oil while we can, get it out of the ground. They might even burn it for energy, at least in the short to intermediate term, because they have it. And as long as you can stick a straw in the ground and get fuel without having to put a lot of effort into it, like fracking, you might do it. So in those 20 or 30 countries, they have oil that they can just stick a straw in the ground and get it. That'll be an impediment to fighting climate change, but it will be something that makes energy very cheap along with the alternative energy in the not too distant future. So all these dynamics, all these things moving around, the fight for global supremacy, the more important fight to raise standards of living, are primarily influenced right now by one entity, the United States Federal Reserve. And I know that the idea is out there that the United States is ripe for a collapse. People have been saying that forever, since the day that the country was born, even before that. That thought process has always been wrong, and it will continue to be wrong. And I know that the people who comment on my articles, sometimes on the YouTube channel, will argue, but the Roman Empire, blah, 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 but this, but that, blah, blah, blah. It's to the point of being so silly that it's boring at this point. Things have been getting better in the United States forever. Generation over generation. It's never changed. Things are getting so easy now that a lot of people choose not to work. And that's a bit of a problem to have 5, 6, 7, 8% of the population that could work not working, above and beyond normal churning in the employment picture. And there's probably some pretty simple tweaks that the government could do if it weren't for buying those votes. But we'll see. I still maintain that the millennials, at some point, with their power economically, and as the baby boomers start to die, and as legislation becomes smarter with regard to taxes, right? We really don't have to raise taxes on anybody in this country if we just get rid of the loopholes. Just getting rid of the loopholes would balance today's budget. But senators like Christine Sinema, I believe that's her first name, like to keep the loopholes for her donors. We need about 10 more semi-honest politicians in the Senate and about 30 or 40 in the House. It doesn't really even matter which party, just semi-honest, not bought and paid for like Sinema. And we can balance the federal budget, which would drive the dollar even higher. And everybody sees that. The IMF sees that. Europe sees that. Japan sees that. The Federal Reserve sees that. The United States sees that. A few months ago, I did an interview with Forex Analytics when the dollar was up here. I mean, I called it within a week that the dollar was going to come down to about this green line. And look at what's happened. From here to here, from the time that I said it. Well, here's what I'll say next. The dollar probably stops near this green line, then on some event is going to rise. Now, the question is, does it get all the way back up here and require intervention, which I think has been occurring, or does it break out? and break things. Because a dollar up at this level breaks things. Broke the dot-com up here, crushed inflation up here, Paul Volcker. And if it shot up here again to this level, we'd break something again. In fact, in 2019, just at this level, it helped break the repo market. We know that there's been stress in the repo market because we can look at that market. And that stress has largely been reduced as the dollar came down. So I'll call this range, this level right here, I'm calling the millennial dollar. I think that this is the area where the dollar wants to be around. And I think it'll act as a magnet. When the dollar's higher, it'll come back. And on the occasion when the dollar goes lower, which will happen for some silly reason, it'll revert back to here. The dollar wants to be roughly at par with the other basket of currencies. That gives us purchasing power. That gives us competitive advantage without disrupting global markets, which are going to be important for us as an exporter of semiconductors, cars, all sorts of technology, certain high-end manufactured goods, food is important, and energy. The United States is on the verge, and I don't mean 10 years out, I mean 2. The United States is on the verge of becoming a major exporter again. You're going to see the trade deficits come down, and that's going to strengthen the dollar. And that's why we don't run a balanced budget just yet, because then the dollar would get so strong that it breaks things. Now, we bought the emerging markets. See if I can add it to this chart. Then I'll shorten the time frame in November. So as the dollar peaked, started to come down, we were buying EMQQ, and look at that rally. A lot of us are up, 30 to 40% on EMQQ? I think a lot of you should be, just from, and look at the dollar drift down here. It doesn't look that dramatic, right? But it is 8, 9, 10% lower from the peak. Up around 112, now it's down around 101. Somebody says in the chat room, I'm up 35% at EMQQ. Yeah, and Shooter thinks that it's going to run into the 40s before it has a mild pullback. I think that's probably about right. I'm not in any hurry to get rid of my EMQQ. Let's just switch over that chart altogether because it has a lot of room to go up. I mean, this first area here is going to be where we hit resistance, low 40s. And then where does it come back to? Well, I imagine that the bottom fishing ends up getting moved to about today's price probably. Because it's at a bit of a breakout point right here, a minor breakout from mid 30s to low 40s. So if it comes back a dollar or two, gets down to the low 30s, 32, 31, and you haven't been buying it because you're scared of emerging markets and the fact that this fund is half China technology, you need to get over your scared. Stop being scared. The rest of the world needs stuff too. So if the dollar gets a little wind at its back, that'll bring emerging markets down. It's your opportunity to buy it. I wouldn't anticipate it setting a new low. I think upper 20s is as good as you'll get, but I'd probably be starting to scale in the low 30s and selling cash secured puts if we can somehow help create a market in that. But right now, there's not a very strong option market here. Other thing you should be looking at, we've talked about this for a while, is the emerging markets bonds. We've been talking about this, 2 months, 3 months? Just starting to come off its bottom. You get a pullback here, you probably want to buy it 85-ish, middle 80s. It's only a couple dollars fall back. In fact, if it just gives back today's gains, it's probably worth taking a look at. Emerging market debts are going to continue to be paid off, and their currencies are going to continue to get stronger over time, but they're highly volatile. So that gives you opportunities. If you're a fixed income investor and making 6-7% of your money is wonderful with a little bit of chance for capital gain, here you go. If you'd prefer to have a 60-40 or 80-20 portfolio, right, with a lower number representing fixed income, this is something that should be in your basket, something to buy on the dips. GMO, Jeremy Grantham's firm, talks about emerging markets all the time, and it is clear that somewhere between 70 and 80% of all the growth on the planet in the economy, and all the global growth over the next 10 and 20 years, 70 to 80% of it will occur in the emerging markets. They will develop bigger consumer economies as more people cross into their middle classes. And that'll be good for the United States, who has good relationships with 2/3 of the emerging markets on the planet, probably more. So between the emerging markets and the United States, those are really the two places I see having the most amount of money. I have zero interest investing in most of Europe. Now you can buy Germany here and there. The UK, now that they're separate again, you can look at them as well. But do I want much of the rest of that economy? No, not really. Maybe some of the northern countries from time to time, but there's better alternatives. I certainly want exposure to emerging Asia. EMQQ does that. And I want to start to get my toes wet in Africa. The opportunity to develop economies in Africa is massive. The problem, of course, is, warlords and crummy government and exploitation by the West and the East. If Africa can overcome the exploitation, if they can develop true partnerships, if they can limit the corruption to, normal developed world levels, they're going to have a lot of growth, maybe the fastest growth in the world, because they're a generation or two or three, probably three, behind Asia. And look at how much Asia has developed in the last 3 generations, especially the last 2. But if you include the post-World War II era from having had to rebuild from war, you can see what might be coming to Africa, which has been in a perpetual state of destruction for hundreds of years. So if we don't blow ourselves up, if the aliens don't come and kick us off the planet or eat us or something, the emerging world is where you want to be. Why do I talk about the emerging markets when we're supposed to be talking about the Fed? Again, it's because the Fed is really there to manipulate the dollar in the direction that we need it manipulated. How can I say that? Well, look at this headline over at Forest for the Trees. There's a growing pile of evidence that a coordinated effort to weaken the dollar was agreed to at the IMF meetings. Now, you might say, well, that's the International Monetary Fund. Yeah, it's basically owned by the United States. So we would have to be in on that. In yesterday's meeting with the Fed, even though he came out hawkish, the market doesn't quite believe him yet. Here's why. Because the market and people who read publications with an Austrian economist tilt think that the U.S. economy is broken. Does it make any sense that the U.S. economy is broken when you see numbers like this? The Federal Reserve has a huge, huge level of protection because unemployment isn't going up. Sure, you're seeing layoffs here in the first quarter and in the fourth quarter before, but it's mainly tech people. They'll take their severance. They'll probably take a lot of summertime off. They might even take a whole year or 2 off. Might do some freelance work. These are not people who are going to find it hard to get work. And if a lot of them become entrepreneurs and start small businesses or even just freelance, which is a kind of entrepreneurship, there's a difference between self-employed and entrepreneurship. I've started 4 companies. That's entrepreneurship. Self-employed is just somebody who has a 1099. Regardless, that is disinflationary. What do I mean? It means that if you're working at Google or Apple or Facebook, Amazon, and you're making pretty good money, you go start your own thing because, hey, I'm already a millionaire or close to it. I'm going to move out of Silicon Valley, cut my cost of living in half or by 2/3, and I'll just consult or I'll do freelance work. I can make it on half as much money because my cost of living has gone down a lot. So to think that the economy is broken when you see these types of numbers and realize that since I've been talking about it, immigration has suddenly come to the forefront in Washington, D.C. again, this idea that the U.S. economy is in trouble is pretty silly to me. Suddenly you have all kinds of people who said that a hard landing was unavoidable, opening up the door for a soft landing. I've been telling you that since it all started. 1.5 years I've been telling you that. It's going to be a soft landing. The only thing that could cause breakage would be international events, mainly war, that drove the cost of energy up again, short term. But because of the way the timeline is moving, even that would be short-lived because growth in the alternative energy space is around 30% per year. All these things are moving so fast to get us off of a dependence on fossil fuels. Not that we won't use them, but the outright dependence is going away quick. Oil is just not going to be that big of a deal by the end of the decade. A decade after that, natural gas won't be. And that's why all the natural gas players are trying to figure out how to get into clean, green hydrogen. Because for heavy industry and energy storage and a number of other things, green hydrogen is going to come. Those supply chains are getting built out now. They'll all be ready by the end of the decade. Some of our companies are headed straight into that. Kinder Morgan, Occidental, Chevron, New Fortress Energy. I would suspect the Metis heads in that direction eventually. We'll see what happens to them. I think they just get bought out, but who knows? Don't underestimate the importance of happening in energy. It affects everything from food production to manufacturing to people's month-to-month bills, which is pretty important to, people. So when the stock market rallies because they think that there's going to be interest rate cuts this year, you should really ask yourself a question. Does that sound likely? In this environment that I described, does it seem likely that we get a cut in interest rates this year? Even one. I think they stop going up by the second half and level off. And I think the QT might get caught a little bit on the heavy side, so they might have to cut QT in half. But right now, we have a ton of money chasing QQQ. And just look at that. This makes it look like that line that I had here actually is the bottom. I find it hard to believe based on fundamentals at the time, but who knows? People like to say that the stock market is a forward-looking mechanism. Then why do we have crashes? I think that the better thing to say about the stock market is that it's schizophrenic. It's overly emotional. And frankly, 4 out of 5 participants are uninformed. They like to tell themselves that they are, but they're not. How many of you read John Maynard Keynes? I mean, really read his books, really studied him. How many of you really read economic history? I'm not saying that to put anybody down. I'm just saying that there's a lot of people who have, and a good deal of them are pretty good at making money in the markets. Now, you can trade this stuff. I won't claim to be a great trader, or you can stick with the bigger cycle stuff because the bigger cycle stuff tends to play out. The problem is you have all these people pretending to be Austrian economist types, which, much like communism, just doesn't understand certain human psychological traits. And you can be wrong a very long time, but convince yourself that eventually it'll be right. Good luck with that. Stake your investing to these premises. 1, the U.S. economy is the strongest developed economy in the world and will continue to be for another generation or 2 or 3. The Federal Reserve manages the dollar and uses inflation and unemployment to justify what it does. And 3, the whole world, people all over the place, just want to live better and safer. If you just take those 3 constructs, strong U.S., a smart, if even a little bit duplicitous Federal Reserve, and people around the world just want to be happy, right? It's right in our founding documents. What you will see is that there is one path, is that things will just keep getting better generation to generation unless we blow the whole damn thing up. The AI or the aliens eat us. We should probably protect ourselves from the aliens and the AI and little Vladdy Putin, but I don't think any of them are really that big a threat. Makes for great science fiction, though. Great war stories. At some point, fundamentals play out, and you have to ask yourself the question, why did Facebook go up 20% today? They're really not doing anything different. Great lip service, though, to efficiency. Google and Apple have a problem, right? Musk is whining about the 30% fee in their app stores, something that I've brought up for a very long time. 30%. Well, why not allow independent app stores access to those devices? I mean, fundamentally, there is a monopoly on the app stores with the various phones, right? If you have an Android phone, you're stuck with the Google App Store. If you have an Apple phone, you're stuck with the Apple App Store. Why can't independent app providers have their own stores? Is 30% legitimate? Is that really what the gate fee should be? Think about being on a toll road anywhere. You can drive across any toll road in America, I believe, for under $10, go across an entire state. What should the toll be to use Apple's or Google's App Store? Should they be able to have platform exclusivity for something that has international standards? Think that through. If there's international standards that are agreed upon for technology, shouldn't it be ungated then? Or at least only a token fee? 30%, that's huge. So that means that these companies that have essentially become oligopolies, at least on their own devices, monopolies, in a world where, what is it? It's 90-something% of the phones outside of China are Android or Apple. It's a big number. If you include China, it's lower because they have AOE. But all these things play into the mix. So you ask yourself, does this make sense? Did all of this make sense? I think we've certainly concluded that it hasn't, or that it didn't. I mean, it was in this price range for all that time. Does a price more in the middle upper 200s on QQQ make sense? Did it just get sensible here? I guess that's the question. I think probably the answer is yes. But even down here, it wouldn't be tremendously undervalued. So on today's rally, suddenly you have to ask yourself the question, what makes the most sense? Are we just in a popularity contest right now? Is the hot money just still hot enough that it can push prices around? Are there enough people transacting, which pushes prices up? right? Because of all the fees in the transactions. I mean, you can say, well, I don't pay a commission on my trade. Yeah, but you don't also get the full price. There's a spread the Citadel takes. I mean, it goes all the brokers, but Citadel, it became pretty clear that they were gaming the system. So when a day like today sees a bunch of transactions, ask yourself what makes sense. Volume isn't even that high after the initial spike, right? Look, it came back down. Ask yourself a question. If you're a trader, or if you're not a trader, ask a trader. What is your conviction to hold these positions overnight? I bet it's not very high. So if you're thinking of chasing, if you're Joe FOMO or Jill FOMO, Jane FOMO, I don't know, what are you going to do when it goes down 2%? Again, I tell you, if you're not a very good trader, if you're not really understanding the technicals, if you're not taking a look at the volume indicators, right? Money flow is everything. You should not be trading. You just shouldn't, because the mistakes that you'll make are massive if you don't understand how this stuff works. You can say, but my system, yeah, whatever. If your system doesn't understand money flows and volume weighted indicators, you're missing the picture. I mean, you can draw lines that match up with your narrative. But again, I've been doing this a long time, almost 3 decades. The great traders understand something that you don't usually. And if you just want to follow the trend, that's fine. But you better be closing your positions often. You better be going flat most days on almost everything. Swing traders understand your catalyst. Position traders just understand the long term and ignore everything in the middle. So I encourage most of you to be position traders, because understanding the big picture, if you're not getting beat up with bullshit and somehow absorbing it into your system, your ideology, your rationalizations of the world, you're going to do pretty well. But if you're believing some of the stuff from these people who lean Austrian economists, who talk about the collapse of the dollar, who talk about the collapse of America incessantly, who lean towards the negative rather than the positive, your account's going to be chronically negative. It's just the way it is. Earlier in my career, I believed in it. I believed in, oh, things are getting worse. For 30 years, I watched as everything got better. Yeah, there's setbacks. But the Federal Reserve is telling you what they are trying to do. They're telling you what they're trying to do. Tom Lee over here at Fundstrat, FS Insight, talked about what the Fed was saying. Powell cited the word disinflation 13 times in the press conference. Didn't use the word in December. He's talking the dollar down. And if something happens internationally that makes energy prices go up and has inflation resurging again, whether that's just China opening their doors or Russia renewing their attacks or something happening in the Middle East, and all three are possible, if not likely, the Fed can pivot and say, hey, inflation's coming back. No pause on raising interest rates. And in fact, we're going back to a half point. The Fed is leaving itself a lot of wiggle room. If inflation really continues to go down, and without an event, I think it will, then they can back off on the interest rate hikes. But if there's an event, and I think the odds are that there will be, the Fed has the ability to stretch out the quarter points longer and not lower rates this year. I think that's the most likely scenario. And if inflation really surges higher on events, then they can raise rates more, right? Pretty easy. 3 scenarios. Disinflation continues, Fed backs off. Disinflation does not continue, and there's upward pressure again. Fed does not back off. Events drive inflation actually higher, the Fed can get tougher because they never completely backed away. Now, you can handicap those things however you want. I think number 2 is the most likely, is that disinflation slows down a little bit, because I do expect the impact, and Shooter and I were just talking about this, and all the reading seems to support it. The Chinese economic reopening from COVID-0 is going to drive energy prices higher and demand for everything higher. They're going to have the same type of revenge spending that we had here. Think that through. A lot more of them. Maybe they won't spend as big, but that's a lot of people spending money again. That might be all by itself enough to offset prices coming down anymore. What did I say? Oh, way back when this all started, I said this: inflation is transitory. Most prices are permanent. Is that easy enough to understand? The inflation will go away, but prices will stay the same. Inflation is what's happening as prices go up, and they get to a certain level, and those prices end up being more or less permanent. Some fudgeability. But it would take deflation to say drive the price of iPhones or cars down. Now, we saw a little bit of deflation in cars just because the Inflation Reduction Act that the Biden administration pushed through forced Tesla mainly and Ford a little bit to push the price of their EVs down to under $55,000 for sedans and small crossovers. Remember, SUVs can still get the tax credit up to $80,000. Kind of interesting how that worked. They originally wanted that bill to only go to labor union companies, but they made it all companies in the United States that are manufacturing, and even some exceptions to the rest of North America. But who makes SUVs and who doesn't? GM and Ford make SUVs, $80,000 limit on the tax break, and Tesla really does not. So that's how they did it. That's how they gave less to Tesla than they did to GM and Ford. As GM and Ford sell the number 1 and 3 vehicles in America, right? The F-150 and then the Silverado. So there's that. That's why government policy is in our process, our 4-step process. Secular trends, analyze the Federal Reserve and the government policy. Then you go to fundamentals, then you go to technicals. It's a big process. That's why I'm opening a hedge fund so that I can make my more aggressive trades with people. I can't do it in my firm, and the regulators don't like that. But with a hedge fund, I can do that. I can make the macro plays and do some of the trading that I can't do with retail investors because I get these things right so often. And I'm a year or two ahead almost all the time. It gives me the ability to make some big trades. So that's what the hedge fund will be for. The Fed, according to this guy, was decidedly less hawkish, mainly because he said the word disinflation. Could it all just be about the dollar? I think it could be. All right. So I'm going to be gone next week. I will do a Stocks of the Week show on Monday with some option trades because I think you might suddenly be profitable on certain positions that you weren't. Unity, I think a lot of you just became profitable. Warner Brothers, those positions might have been too big for your portfolio asset allocation because you had to scale in to get your price down. So if we see this rally continue through Friday and especially into Monday, which is a coin flip, always is. But if we see some follow through for the next couple of days, we might want to actually write some covered calls, not so much to generate the income. I mean, that's nice, but really to systematically scale out of positions that are too big. So that's what we'll talk about on Monday. We'll take a look at what happens over the next 2 days of trading and see if the FOMO rally takes hold or if this is just a fart in the wind. My guess, it's a little stinky. All right, I'll catch you on Monday.